Three numbers. That is all it took. Three numbers released within hours of each other on the morning of April 30th, 2026, to confirm what historians of monetary catastrophe will one day mark as the moment the economic fog lifted and the terrain beneath became terrifyingly clear. Not to Wall Street, not to Washington, but to anyone with the patience to read what the data was actually saying rather than what the anchors were paid to make it sound like. The first number. Q1 GDP came in at 2.0%. It missed the consensus forecast of 2.3%. It missed the Atlanta Fed's own internal GDP Now estimate. And it arrived on the same morning that Brent crude oil was trading at 114.66 cents per barrel, the highest intraday level since June 2022. That is not a coincidence of timing. That is the definition of stagflation, written in the official language of government data and stamped with the imprimatur of the United States Bureau of Economic Analysis. The second number, core inflation, at 3.2%. And here is the word that Jerome Powell himself chose in his final press conference as Federal Reserve Chair to characterize that figure. He said it was moving, and I quote the man directly, in the wrong direction. Not moderating, not stabilizing, moving in the wrong direction. The departing chairman of the most powerful central bank on earth, speaking in his last official act before handing the keys to Kevin Warsh on May 15th, told the assembled press of the world that the inflation he was supposed to have contained is instead accelerating. One finds it difficult, in polite company, to describe the magnitude of that admission without reaching for adjectives that would embarrass both of us. The third number, 4. 4 members of the Federal Open Market Committee dissented at yesterday's meeting, the highest number of internal dissenters since 1992. 3 of them wanted to strip the easing bias from the policy statement entirely, meaning they believed the Federal Reserve should not even be whispering the word cuts in public. 1 dissenter wanted an immediate rate reduction. The institution that sets the price of money for the entire global economy just fractured, publicly and on the record, in 4 separate directions simultaneously. And now silver. As of this week, silver sits at approximately $74 to $76 per ounce, having pulled back sharply from its January peak above $121, down roughly 38% from that high. The paper market, responding to a temporary strengthening of the dollar driven by oil repricing in dollar terms, has pressed the metal lower. And here is the critical question, the one that separates the informed observer from the crowd. Is this a market in trouble, or is this a market in the most historically precedented, most structurally loaded setup that the modern precious metals era has ever produced? To answer that question honestly, you must go back. Not to last quarter, not to last year. You must go back to 1973, and you must understand what happened there with enough clarity to feel it, not merely recite it. In October of that year, OPEC imposed an oil embargo on the United States in retaliation for American support of Israel in the Yom Kippur War. Oil prices quadrupled within months. The shock arrived into an economy already carrying the kindling of years of expansionary monetary policy, and the Federal Reserve found itself in a trap that no elegant theoretical framework could dissolve. Raise rates to kill inflation, and you crash a slowing economy. Hold rates or cut, and you let inflation devour the purchasing power of every American who had done the responsible thing and saved in dollars. There was no clean answer. The men in the room knew it, and the market eventually made them pay for not having one. Silver in January 1971 was trading at approximately $1.29 per ounce. By January 1980, it had reached $49.45, a gain of roughly 3,700% across 9 years. Not because silver reinvented itself, not because some revolutionary new application was discovered, but because a stagflation environment, defined precisely by rising prices colliding with slowing growth against the backdrop of a trapped central bank and a Middle East energy shock, destroyed the purchasing power of paper currency so completely and so persistently that physical assets absorbed in their price the real value that dollars were shedding with every passing month. Now look at today's map. In 1973, oil quadrupled because of a Middle East embargo. In 2026, Brent crude has surged from roughly $67 before the current Iran conflict began to over $110 today, with intraday spikes above $114 last week. The International Energy Agency has described the Strait of Hormuz disruption in language that should arrest anyone's attention. More severe, in their formal assessment, than the 1973, 1979, and 2002 energy crises combined. In 1973, The Fed was unable to raise rates aggressively enough to break inflation without triggering a recession. In 2026, the Fed has held rates at 3.50 to 3.75% for 4 consecutive meetings, while oil burns above $110 and core inflation moves, in the chair's own words, in the wrong direction. The parallel is not impressionistic, it is structural. And structure, in markets, is what matters when the sentiment finally catches up to the mathematics. There is a temptation, when examining any compelling historical parallel, to stop at the surface resemblance and declare the case made. The intellectually honest analyst resists that temptation. He asks not merely whether the pattern rhymes, but whether the underlying mechanism is the same, and whether, in any critical dimension, the present version is more or less severe than the historical precedent. In the case of silver and stagflation, the answer to that final question should concentrate the mind considerably. The 1970s stagflation trap had, fundamentally, one wall. The Federal Reserve was caught between fighting inflation and protecting a slowing economy. It was painful. It was prolonged. It took Paul Volcker raising the federal funds rate to 20% in 1980 to finally break the cycle. But Volcker could do that because when he did it, the United States national debt stood at approximately $400 billion. The Treasury could absorb the higher borrowing costs. The system could tolerate the medicine, even though the medicine was brutal. Now consider the present arithmetic. The United States national debt today stands at $38.5 trillion. Interest payments on that debt are projected to reach $1.039 trillion this fiscal year, the first time in American history that debt service has exceeded the entire defense budget. The Government Accountability Office has confirmed that $9.7 trillion in maturing Treasury debt must be rolled over in this fiscal year alone at current elevated interest rates. Every single basis point the Federal Reserve raises rates adds billions of dollars to a Treasury interest bill that is already structurally unsustainable. Volcker's solution does not exist in 2026. The debt load has made it mathematically impossible. What this means is that the 2026 stagflation trap does not have one wall. It has two. On one side, inflation at 3.2% and rising, demanding higher rates. On the other, $9.7 trillion in Treasury rollover debt that cannot survive aggressive tightening without triggering a bond market crisis of sovereign proportions. The room is smaller, the ceiling is lower, and the Fed stands in the middle of it, having just fractured into 4 competing factions in what the departing chair himself described as a really hard time knowing what to do. I want you to sit with that phrase for a moment. Jerome Powell, the man who ran the most powerful monetary institution in the history of global finance, in his final official statement before retirement told the world, "We do not know what to do." He named the trap, 4 supply shocks in succession, pandemic, Ukraine, tariffs, and now Iran, and he said plainly that each one has the capability of driving inflation and unemployment higher simultaneously. That is not hedged Washington language designed to obscure reality. That is a confession, delivered in public, by the man who is supposed to have the answer. And now, Jamie Dimon, the chief executive of J.P. Morgan Chase, not a gold enthusiast on a podcast, but the most influential private banker in the Western world, said this week that a bond crisis is coming, and then we will have to deal with it. When the head of the largest bank in the United States uses the phrase bond crisis publicly, without qualification and without apparent concern for the panic it might cause, he is either reckless or he is certain. Neither possibility is comforting to holders of dollar-denominated assets. Here is what happens, historically, when the Federal Reserve is trapped between 2 walls simultaneously. The dollar erodes. Real yields, meaning nominal rates minus actual inflation, go deeply negative. Investors and sovereign wealth funds, watching the purchasing power of their dollar holdings diminish without adequate compensation, begin diversifying out of those holdings. The money flows toward assets with intrinsic, non-debasable value. It flows toward gold. And then, with more force and more velocity, it flows toward silver, which sits at the precise intersection of monetary metal and indispensable industrial commodity. This is not a theory. This is the transmission mechanism that operated throughout the entire 1970s stagflation decade, and it produced 3,700% gains in silver across 9 years of corrections that looked, at each individual moment, like the thesis was broken. If you are watching this and you have been following this story, if you have felt that something important is happening in the macro environment, that the mainstream financial press keeps describing in terms designed to minimize rather than illuminate, then I want you to do something right now. Hit the subscribe button. Because what is coming in the next 60 days, the Warsh transition, the Iran military briefing to Trump on expanded strike options, the next inflation print, will move faster than any of us can manually track. The people who understand the mechanism before the crowd arrives at the conclusion are the ones who make history-grade decisions rather than panic-grade ones. Subscribe and stay. Now let me turn to the physical silver market, because there is a layer beneath the macro drama that the GDP headlines will never capture, and it is the layer that ultimately determines whether a paper price dislocation becomes a price correction or becomes a reckoning. The World Silver Survey 2026 has confirmed the sixth consecutive annual supply deficit, with a 2026 shortfall of 46.3 million ounces. Since 2021, 762 million ounces have been drained from global above-ground stockpiles. COMEX registered inventory sits at approximately 76 million ounces, against open interest of roughly 576 million paper ounces. That is a coverage ratio of 13.4%, below the 15% danger threshold for 6 consecutive months. Silver's paper price has pulled back from January's high above $121 to the current range near $74 to $76. It pulled back not because the physical market deteriorated, not because a single solar factory canceled a procurement contract, not because one EV assembly line went dark. It pulled back because Brent crude, at $114, briefly strengthened the dollar, as oil demand reprices in dollar terms, and a stronger dollar mechanically depresses the paper price of silver through futures market dynamics that have nothing whatsoever to do with the supply-demand fundamentals of physical silver. The sixth consecutive deficit did not reverse when the paper price fell. The 762 million ounce stockpile drain did not reconstitute itself. The solar farms, the AI data centers spending $715 billion in committed capex this year alone across Meta, Alphabet, Microsoft, and Amazon, none of them rewrote their silver procurement schedules because Q1 GDP printed 2.0 instead of 2.3. The physical drain is indifferent to paper market mechanics. In the stagflation macro environment, the one that was officially documented in government data on April 30th, is precisely the environment that throughout all recorded monetary history forces the paper price to reconcile with the physical reality in the most abrupt and spectacular manner possible. Let me now address a question that serious analysis demands we ask, even, perhaps especially, when the bull case appears overwhelmingly strong. What could go wrong? Because a thesis that cannot survive honest scrutiny of its own vulnerabilities is not a thesis. It is a wish dressed in the language of analysis. Silver at $74 to $7.06 per ounce today can go lower before it goes higher. If Brent crude spikes above $120 and the dollar strengthens further on safe haven demand, the paper price faces a support zone somewhere in the $68 to $70 range. If incoming Fed Chair Kevin Warsh, who takes the helm on May 15th, signals a more hawkish posture than the market currently prices, and the CME FedWatch tool has already registered a rate hike probability for 2027 that barely existed 3 months ago, paper silver faces meaningful additional headwind in the near term. And the stagflation parallel, for all its historical precision, does not come with a calendar. The 1970s stagflation lasted the better part of a decade. The investors who timed it with leverage at the wrong moments were financially destroyed even while their long-term thesis proved correct. They were right about the destination and wrong about the path, and the path killed them. This is the warning that serious commentary must deliver, regardless of how uncomfortable it makes the broader argument. Position sizing matters. The volatility of this market is not the volatility of a stable asset experiencing temporary disruption. It is the volatility of a market at the intersection of a Middle East energy war, a structurally trapped central bank, a sovereign debt overhang of $38.5 trillion, a paper-to-physical coverage ratio below 14%, and a leadership transition at the Federal Reserve happening in real time. Each of those factors alone would be sufficient to produce dramatic price swings. Together, they produce the kind of environment where people who are right about the direction, but leveraged beyond their conviction, lose everything before the thesis plays out. Size for the actual storm. Not for the storm you could emotionally survive if you happen to be right at every step. Now let me conclude with the full picture as it stands on May 2nd, 2026. Q1 GDP printed at 2%, missing the consensus of 2.3%, driven in meaningful part by temporary government shutdown recovery spending and Iran-related defense outlays, not by the broad-based consumer demand that constitutes genuine economic momentum. The underlying consumer was flat on goods spending for the quarter. Brent crude hit $114.66 last week, its highest intraday reading since June 2022, and has since eased to the $108 to $111 range as Iran's updated diplomatic proposal to the United States was communicated through Pakistani intermediaries, though both the naval blockade and Tehran's control of the Strait of Hormuz remain in place, and the Pentagon's own assessment is that mine clearance could take up to 6 months after the war formally ends. The war has not formally ended. Core inflation is at 3.2% and moving, in the words of the outgoing Fed chair, in the wrong direction. 4 FOMC dissenters, the most since 1992, have documented publicly that the most important monetary policy committee in the world has no consensus on direction. And Kevin Warsh inherits all of this on May 15th, along with a fractured committee, a Treasury drowning in rollover debt, and an energy shock that the IEA has called historically unprecedented. Silver sits near $74 to $76. It peaked above $121 in January. The physical market has run 6 consecutive annual deficits. The paper-to-physical coverage at COMEX is 13.4%. In 1971, silver was $1.29. In 1980, silver was $49.45. That is 3,700% across 9 years of a stagflation decade that, in multiple critical structural dimensions, the size of the debt overhang, the severity of the energy supply disruption, the institutional paralysis of the central bank, the absence of a Volcker-style policy option, was less severe than what the official data is now describing in 2026. The investors who made the 1970s silver trade were not, to borrow a phrase from that era's own vocabulary, visionaries. They were readers. They read the official data, recognized the pattern, and positioned themselves before the paper market caught up with the physical reality. The GDP miss of April 30th is confirmed. The oil shock is confirmed. The core inflation trajectory is confirmed and moving the wrong direction by the Fed chair's own public testimony. The FOMC fracture is documented for the historical record. The stagflation structure is in place. History does not announce itself with a press release. It announces itself in data. On April 30th, 2026, it announced itself in data again. Whether you act on that announcement, at what size, and with what risk management in place, is a decision that belongs entirely to you. Now here is what I want you to do before you go anywhere. Drop your silver price target for the end of 2026 in the comments below. Not because it will be precisely correct. No one in this business is precisely correct about timing, but because articulating your thesis forces you to examine it. And examined theses, stress-tested and honestly interrogated, are the only ones worth holding when the paper market moves violently against you at the worst possible moment and asks you to abandon everything you understood when the facts were still clear. Write the number, defend it to yourself, and then ask yourself whether you understood why. That question, honestly answered, is worth more than any price target any analyst has ever published. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.